Welcome to SectorExchange.com. I'm Jim Farish, founder and editor of SectorExchange.com. When we launched our website some 10 plus years ago, one of the challenges that we looked at in the marketplace today was a simple thing or strategy that had been around for many, many years is still talked about to some degree, which is called sector rotation. And being a professional money manager for the last 30 years, one of the things that I've always focused on is sector rotation and looking at what happens within the sector universe. And as we've kind of gone through these things over many, many years, one of the challenges that we keep coming back to with individual investors is keeping them focused on the market broken down into parts versus talking about the market as a whole. And then the second thing is the ability to look at the market relative to those parts versus the whole, and then break it down or dig into the pieces to find individual stocks. And that, I think, is where, the greatest challenge really comes in. I wish I had time to go through all the particulars as to what I mean by those two comments. But very briefly, when you look at the parts versus the whole, the parts are the subsectors of the market. They're the pieces of the market, if you will, that make it work. And I'm going to pull this down so that you can look at it in a format. This is just Telechart 2000. And when we talk about Telechart, one of the things that we talk about quite frequently with people is the ability of this software to break the market into pieces quickly so that you can see it and manage it in a format that works for you. Now, this just happens to be one of the desktops that I work off of. We'll come back to that, but I want to look at this sector rotation desktop that you can actually download from Telechart. If you're a subscriber to Telechart, you just simply go out and you can download this desktop from their web page. And one of the things that we're looking at here is that over here to the left is essentially there are 10 sectors of the S&P 500 that we look at on a regular basis. And you can see them: energy, basic materials. And we look at those and then we chart them. The top chart, these are just daily charts, is 5 of those charted, and the bottom is the other 5 ETFs. And you can see them written right across the top here. And we're going to come back to this page and we'll decipher what this is. But when we talk about the parts of the market, we talk about these 10 components. In other words, that's what we're looking at, are the 10 pieces of the market and the U.S. markets broken down by the S&P 500. And I understand that those are large cap stocks. I understand all the other things. But when we break down those 10 sectors, they account for 75% of the U.S. equity market. So they account for the lion's share of what's out there for us to filter into, dig down, and look at the sectors by the second component of what we had talked about, which is digging into the pieces. So look at the parts in light of the whole, but when you find the parts that are moving, dig into the parts. And we have a whole video series that we've done on digging into ETFs for trading. And I think that it's still, we recorded that over a year and a half ago, and it still is applicable today as it was the day we recorded it, but it's also just as applicable as it was 25 years ago when I learned it, and that is find the pieces of the market that are moving and get into those parts. That's what the whole idea really boils down to from my perspective on a day-to-day basis. So we titled this series Secrets of Sector Rotation. I don't think there's any real deep, dark secrets. I think they're all been laid out before, so maybe we should call this Reminders of Sector Rotation more so than anything. But this is really the crux of the matter, is how do we get in and find the parts of the market that are moving? How do we dig into the research components of the market? And if we put up here the S&P 500, and we say, all right, if the trend, this just happens to be, as we're recording this, you can see the consolidation that had resulted in this period, and then a break to the upside. So a shift in the trend, if you will, on a short-term or micro basis, being the very shorter period that the market had started to move to an uptrend. So when you get a trend change, what leads it? I mean, this is very simply one thing that you can look at with the markets, and that the S&P 500 during this period of time had consolidated and then started to break up. Here you can see on around the October time frame, it started to break up. So if we go back to Telechart and we look here and say, all right, what was leading this in the environment of what we're looking at here on the chart, let's pull this out here, and you can see that I'm going to eliminate some of these out of here. But what we have are the ability to go back and say, all right, let's look at the bounce off of the bottom. And we're going to take this simple tool here, which is the custom date sort, and I'm going to come back over to the charts, and I'm going to say back in the October time frame, which we can see right in here, what over the first 7 trading days, let's just look at this from October the 3rd, which was the bottom, and then we can go the 3rd, the 4th, 5th, 6th, and the 7th. So there's 5 trading days, and you can see the market moved off of its lows by 5.1%. Let's look at what was leading the market, and we pull this over, and here's our custom date sort, and we're sorted from top to bottom by what was leading the market out of that time frame. And as we look at this, you can see XLB, which is basic materials, XLE, which is energy, XLY, which is consumer services, industrials, telecom, technology, that's the S&P-Y is the S&P 500, financials, healthcare, then consumer staples, and then the bottom was utilities. And that's really, so what you're seeing is more of a commodity move or energy-based move off of the lows, along with the consumer-driven sectors were driving the market. So if we wanted to capture the leadership off of the lows, then every day that this bounced off of that low, we could actually say what happened. So if we look at XLE Energy as an example, went up 7.75%. Let's go back, grab that custom date sort tool, and do the same thing. If we go from the 3rd out to around the top of this, which was around this period right in here on October the 27th, we can see that it was up 16.86% during that run. We click OK. Now we can come over and look at the same sort, and that energy, which was up 7.75% right here, was totaled up 28%. So even if we bought it after it moves up 8% off the low, we still capture 20% of that leading move to the upside. And that's why we follow sector rotation so emphatically, is looking for, 1, moves off the bottom, 2 is acceleration moves within an uptrend. A lot of different things that you can scan, filter, and look for that will lead you to these uptrending sectors. But when we talk about the secrets of sector rotation, that isn't really a secret. I mean, that's been around for a very long time. Here's the secret, is why don't people still use it? In other words, why are we still looking and scanning? And I don't know. I find people doing all kinds of crazy things. And, some of them work, some of them do not. And I'm not going to say that some are better than another. I'm not saying that mine is better than anything else. I'm saying, why make it so complex? Why can't we go back to the simple rules of money management? And first rule of money management is don't fight the trend, which some people insist on doing. The second rule that I have is buy and hold is dead. Now, I started in the business back in 1978. We started looking at portfolio management. And then when I graduated from college and moved on in 1981, 82, and we started to look at doing this on a professional basis, it really got interesting to me by the mid-'90s how much we were ingrained into buy and hold mindset of managing money. And not to bore you, but to go back for a second and look at financial markets over the longer term period, I just want to go back and look at, we have the S&P 500 up here. Let's just put up a quarterly chart and try to go back. You can see going back all the way into the 70s and 80s, we had a very methodical market. But if you look at during this period right in here, we had a couple of very major corrections, the first of which was 1987, which many people remember, October 19th, 1987. I remember it only because I was there managing money and the headache that created for the financial markets. And then the first Gulf War, which was in the early 90s, was one of the first financial crises that we had in this country on the savings and loan debacle. And we saw a lot of defaults on commercial real estate. At that time we thought it was more dramatic than anything in history, but it kind of paled in comparison to what we came and to believe and understand in 2007 with the housing market collapse. And the bond derivatives that were issued in that environment were much uglier as a result. But back in this period, we started to question, are markets changing? In other words, are things changing in such a format that certain environments are driving the market from a fundamental viewpoint? And we came to the conclusion in 1990, going back and looking at 1990, really made that conclusion in 92, 93, that the markets were starting to change. We saw some corrections in 94 that really started to solidify what we thought. So we really kind of launched these whole sector rotation models back in 1995, even though that wasn't the vogue thing to do back then. But you have to look at what is driving the markets from my perspective, and that's how we really started to manage money on a professional level in 1995, was watch the leadership of the market. And you can see this climax run that the market went on from 95 through 2000. I mean, when you compare this chart goes back to 1963, but look at the methodical move to the upside all the way up through the tax law changes in 1982. We accelerate into the economy, based on what Reagan had instituted under his administration for cutting taxes, stimulating the economy. And it worked very nicely, and it accelerated even further. And then we got this climax run as the United States economy really boosted itself much like China has, I guess, is one of the better examples from a recent time frame. And then somebody pulled the rug out from under it. It fell, rallied, fell, and then you've seen the recent rally. But this right now is where our markets stand, and that's extreme volatility relative to anything we saw prior to. And if we were to go down here on this portion of the chart and we started to draw what we would call a median trend line, which I'm not going to draw it perfectly, you can see that we're still well accelerated off of what the trend should have been relative to conservative market cycles. And even if we use an accelerated trend line off of the period from the early 80s and 90s, you can see that acceleration off of that even started right in here through the mid-90s and it accelerated higher. But look at this touch back here, and these lines aren't drawn perfectly, but this low coming off of the 2008-2009 correction started to come back into line with that trend line that is there. And I still think the markets are still ahead of themselves from a timeline, and that's why I think we're going to still continue to see increased volatility in the global markets as well as the U.S. markets going forward. But that's just my own theory relative to the things that I see in the market environments today. And that's kind of an elongated explanation as to why we got into digging into ETFs and looking at just digging into sectors and finding the pieces that are moving, because the tremendous amount of money that can be made on these big spikes to the upside is dynamic. On the other side of that, the inverse ETFs, which are now in existence, give you opportunity to experience that profitability on the downside. So what we've done is we've broken this out into 5 parts or so here, 6 maybe, and what we're looking at is how do we filter, dig into, and dissect the components of this market so that we can actually put it into play. How do we put all this into actual, practical, simple ways to monitor the markets, whether we want to do it daily, weekly, monthly, however you choose to scan or filter the market. The concepts work regardless of time frame. Even if you want to do intraday trading, you can use the same concepts for what's leading the market day to day. It doesn't really, time frames are not a factor of the principle. The principle is following market leadership, capturing that leadership, and then using it so that you can manage your money with confidence. And I think that's really one of the key components of what we'll cover in this program. So if you go forward with us, we'll go through all the parts of this. We'll break it down. We'll talk about some of how the different pieces of the software function within what we do, how you can scan the markets, how you can filter the markets, how you can use different concepts that are very simple. They're not, I'm not going to get into complex because I don't think you have to be complex. And if you follow anything that we do over time, one of the things you will find is that the whole theme is keep it simple. The simpler it is, the more likely that you'll actually do it. The harder it is, the more complex, the less likely that you'll actually do it. So I hope you'll follow on along with us as we continue this. If you're a subscriber to SectorExchange.com, you have access to this program through your membership to the website. If you're not a subscriber, you can purchase for $99. You can try the website for 90 days. We'll include all of this program with that. It follows along with sector rotation, and it will also go along with only ETFs, and you can follow along with the only ETF trading model. Uses the same thing. The difference between SectorExchange.com is that it tries to take a little bit of a longer-term perspective, being 0 to 18 months. Only ETF's trading model is just that. It's a trading model that goes out 0 to 9 months, generally on the long end of the holding periods, and that's how it works. The one egg strategy is to find the one sector that's accelerating to the upside, and we use the same filtering processes, but there we're looking for a little bit more momentum, more trading-oriented. But we use the same base principle, which is what we founded Sector Exchange on, which is sector rotation. What we're looking for is the leadership, the deceleration, all of those things that people talk about when they talk about the markets is really sector rotation and momentum, deceleration of sectors, volume. All of those components really play into this. And then the other thing that we throw in here that we think is vital is fundamental data. And I don't hear enough talk today about fundamentals. I hear more and more people talk about technical analysis than ever before. I love technical analysis, don't get me wrong, but I do believe that you have to have a fundamental understanding of what's going on in the market fundamentally. In other words, what's happening to the economies and the geopolitics and all of those things, because outside market influences do influence what happens on inside the market on a day-to-day basis, week to week and month to month. So all of those, I think, are very important. So what are we going to cover in this program as we go through it? One, we'll talk about the simple approach to money management we've talked a little bit about here. We'll talk about economic influence on sectors, how they do, how it does matter, how it does influence what's going on, and why economic cycles are a vital component of sector and rotation. We'll talk about understanding market influence, who has an influence on the market and why. We'll talk about fundamentals and why they still matter, which I just mentioned. We'll talk about trend analysis, which is one of the biggest things that we use, is just tracking just basic, simple principles of trend analysis and looking at what's moving it and what's not. When you combine trend analysis and fundamental analysis, I think you get some very dynamic pieces that will help you. Talk about follow the leader, the old game that we all used to play. And then we'll talk about scan, watch, and trade, which is what we do every day. Is we scan the market, we watch the market, and we trade the market. So we're looking at it from different time intervals on a day-to-day basis, but we're always looking for what opportunities reside within the market. So we'll go through all of those pieces throughout this program, and hopefully you'll glean from this opportunities that you have as an investor. So if you're not a subscriber, you can call 1-800-369-5759, 1-800-369-5759, and we'll be happy to answer any questions that you have relative to that. and you can subscribe on the phone, or you can simply log into sectorexchange.com and you can subscribe online. If you like access to this, there'll be a link, simple link here on the homepage that will link you to the ability to subscribe through the use of this video series. So with that, I wish you the best of investing, and I hope to see you at some point in the future.